Good morning. It is March 6th, 2020, and we are still in the grips of the coronavirus COVID-19 stock market correction. I've written a couple of articles about that this week on Seeking Alpha. So if you haven't had the chance to read those, I encourage you to go ahead and do that. Just go to my profile at Seeking Alpha, and you can find the 3 articles I wrote. That coronavirus was the match that lit overvaluation tinder. The stock market's been very overvalued. We've covered that in the last couple of weeks and even months, that we knew some sort of a correction had to come. Coronavirus is what triggered it, although I think something else would have triggered it by probably April or May. So we're really just experiencing something a little ahead of time, in my opinion. We had a couple of those big up days that were alternating with the big down days. And probably 7 or 8% ago, I said coronavirus will spur a much deeper S&P 500 correction. It looks like we're on our way to that. And I will show you something from Goldman Sachs in a second that those of you who follow or are members are going to say, oh my God, that's right where Kirk said it was going to go. And then I wrote a little article, Jerome Powell can't fight the coronavirus bear. The gist of this is that the only thing the Fed can really do here is help corporations with some liquidity issues through the banking system, but they really can't promote any sort of growth with monetary policy. They were having a hard time with that to begin with, but in the case of an illness that's getting people to cancel travel plans, and corporations across the world right now are shut down, mainly in China, which is a quarter of the world economy. Germany's having a problem. Singapore's having a problem. South Korea's having a big problem. Japan's having a problem. And we're just starting to see the spread of coronavirus here, to the point where school closures have already been announced at certain places on the West Coast. And it looks like even in New York that's coming, and probably in Florida. So in places where tourism and business is a big part of the local economy, those are places that are, at risk right now. I'm headed to Arizona in a few days for spring training, and I have tickets to 2 games. I'm pretty sure I'm going to tough it out and go. It should be 80 plus degrees there. I'm not too worried about this from a health standpoint. However, I monitor it and I check my temperature. So, it's worth taking precautions. We went to Costco yesterday and loaded up on Lysol or Clorox wipes, I think they were. And, I don't know what that's going to do in our house, because if we don't have it, we don't have it. And if we have it, we already have it. I don't know what good it's going to do. So I'll probably bring some of those wipes on the Southwest Airlines flight. Hopefully they are sanitizing those airplanes after every time people are in or out, but I'm going to wipe down my seat anyway and the area around it. In any case, the coronavirus is serious. I know there's some people out there who are poo-pooing it. The reality is that it is relatively fast spreading, almost as easily as the flu, maybe as easy as the flu. We don't know quite yet. And right now, in places where it went undetected for a while, like China, the death rate is well over 3%. It looks like the anecdotal evidence so far, we don't have the statistical representation just yet, is that the death rate will be down around 1 to 1.5% when all is said and done. Closer to 1%, where early treatments can be administered, and good treatments. You need a respirator machine if you develop symptoms. But 80% of people really don't develop any symptoms. Of the 20% that do, several percent of them at least need to be hospitalized in most cases. So, it really is probably most of the 20%. So the problem we'll face is if this does spread, is that there'll probably be a shortage of respirator machines. Hopefully that's not true. So I would caution everybody, if you're traveling somewhere that has a lot of tourism from the Far East, I'd probably rethink that. If you're going somewhere that doesn't have much tourism from the Far East and not many people who go to places that are frequented by Chinese and Asians at this point, you're probably okay. The outbreak in Italy was traced to a handful of people who got exposed and then, unknowingly spread it into their towns around Milan. So it does spread pretty easily. But as we detected earlier, as tests come online, things like that, this probably will be the worst season for this, even if it comes back next year. The problem with all of these coronaviruses, and you should really take the time to learn a little bit about this, is that it's a whole class of diseases that mutate. And the one that we're afraid of, disease X is what it's titled, or what they're looking for, is one that spreads this easily, but kills the way SARS or MERS did, which were 10 and 30%. So that's the pandemic that we are afraid of. And that's why biotech companies that we follow are important. So I released our top 10 growth stocks today. Before that, I released our top 10 dividend stocks. Now, if you remember, you can see the list of stocks, and this is on top of our 12 must-own stocks. So these 32 companies, our must-own stocks, our dividend stocks, and our growth stocks, that's a great way to build a portfolio of stocks. Now, somebody asked earlier, and I want to address this right off the bat, how many stocks should I own right now? And somebody else talked about they own 70 stocks. My advice is that you should really never own more than 30 stocks. Why? Because you can't possibly keep up with 30 companies. Can't be done. I do this full time, and I have a hard time keeping up with, the 4 or 5 dozen companies that I really keep up with. Now, we have a list with about 200 companies that make our initial screening, and we actually have several lists, right? Our very short lists are made up of a dividend growth list, a retiree low volatility dividend, and an alternative high income that we're adding to right now. We have a sustainable growth list. We have our ETF favorites. And then we have a speculative trading list. We have an international list. So those 7 lists, each one is 20 to 40 stocks. We also follow the Dow Jones Industrial Average, which we'll be looking at some of those companies today. So around 200 companies we're covering. But to think that you can keep up with 70 of them, or 100 of them, or 200 of them without doing this full time, and even with doing this full time and using some artificial intelligence like I do, it is overconfident at least. It is almost completely impossible to keep up with more than 40 or 50 companies. You just can't do the reading. So I encourage anybody to get your portfolio to between 20 and 30 stocks. 30 if you're a retiree, you want a little bit more diversification. But remember, for most people, you should keep a quarter or half or 3/4 of your money in ETFs. Now, if you're young and getting started, until you got your first 50 to 100 grand saved, you just dollar cost average in the QQQ and add a few other ETFs that offer exposure to the correct sectors of the economy, which we've talked about as well. Just eliminating the bad sectors of the economy and focusing on the good sectors of the economy with some, exposure in the middle. Generally, you'll beat the stock market by around 50%. QQQ beats SPY all the time, which is why in my articles here, I focused on the S&P 500. The S&P 500 has around 100 to 150 companies that I think are going to lose at least 50% in the next decade. A lot of them will go to zero. So you have to have the right indexes to follow when you're getting started. You have to have the right ETFs in your core portfolio. So even if you're purely a dividend investor and maybe you're selling options along with us to generate even more income, you still want a quarter of your money probably in ETFs to get the broader diversification and exposure to the correct parts, the better parts of the economy, which there are parts of the economy that are almost always at risk. I never invest in banks, ever. Why? Because in a recession, they get hit the worst. They just do. So on top of that, in this low interest rate environment, they can't make any profits. The Federal Reserve is trying to pump them full of money, but they're hugely at risk right now. I think the banks could lose 50, 60, 70% again sometime in the next decade. Do you want to be a part of that? They don't have secular growth anymore. So, with the populace becoming less tolerant of bankster mentality, why would you want to be in banks? The other place that you want to avoid is fossil fuels. We had to learn this one the hard way. I had to learn this one the hard way. Oil treated me well for 15 years. And I've ridden these waves here the last 5 years, gotten the story mostly right, but trading it's been very difficult. And I'm to the point where I only own 4, oil companies anymore. And I don't own any oil funds. I don't own any natural gas stocks because natural gas is not the bridge fuel that we thought it would be. Alternatives are taking up 100% of new capacity and 2/3 of the coal plants to close. So natural gas is not really seeing growth. And we have it coming out of our ears. So we need to make sure that we focus on the smart everything world, the alternative energy world, and some resources that will be important to that. For example, zinc, copper, things like that, lithium, and whatnot. So with our 10 dividend stocks, I think that you, as a retiree, should own all 10 of these. I think you need to own our top 12 must-owns, and I think you should own some of our growth stocks. So what I want to do in the context of what's going on with the coronavirus is talk a little bit about growth stock investing today, and then we're going to take a look at some charts of companies that are in the Dow Jones Industrial Average, that I just picked randomly. So growth during versus dividends, the throwdown. There's this idea that dividend investing beats growth investing, and nothing could be further from the truth, The reality is that growth investing has done very well forever because it, in fact, is what drives the economy. Those are the companies that are profitable. So if a company adds a dividend down the road, it means that they were a growth company first. It's only logical. They grew to the point where they had enough cash to throw off to investors. I want to introduce something to you that I've talked about, but we really haven't put into a graph. So I went and grabbed this chart out of an academic report, and I've known about this. You have your curves, your S curve, and the S curve is what everybody talks about. But really, what companies have is a number of overlapping S curves, right? They have their first mission. What was their first product to market? Then what was their second product or third market? And this representation is simplified. It doesn't show like Google would have 20 of these overlapping at different stages, right? But as a company gets up here and starts paying a dividend, right past here, past the midpoint usually, then as it gets up here, it runs into some challenges. And a lot of companies are up here and they're going to go like this. And that's what I've identified with over 100 S&P 500 companies. Over 100 S&P 500 companies are up here paying a dividend right now, and they're never going to get a new innovation curve. They're never going to be able to grow again, and they're going to fall. Philip Morris, ExxonMobil. I'm telling you, Exxon's in big trouble. Philip Morris is in big trouble. People don't want to hear that because they look and say, well, look what it did. Yeah, but you should look at what it's going to do. It would be extremely expensive for either one of those companies to do this anytime soon. They just have such a big overhang, such a big legacy problem, such a secular headwind with both of those companies, Exxon and Philip Morris, that for them to succeed here is a long shot. Or if they do succeed, it'll be many years off and after they've collapsed in share price. So I frequently talk about companies in transition. You've heard me say that how many times? 100, 200, 300? Companies that get up here usually get to this point and the stock price drops only because people get fearful that they'll be able to do this. Now, a good company has kind of several of these curves going at once, so they never get to this either or spot, right? Exxon, Philip Morris, they're at an either or spot. Either they're going to reaccelerate or they're going to decelerate, and my money's on decelerate. Most companies have several of these curves, so like I said, they never get to that specific spot. They have several curves going, and they always are pushing up. What companies have many, many curves going? It's the companies that invest in research and development. They're generally asset light, meaning that for every dollar they put in, they get 5 or 6 back. Not they put in $1 and they get $1.30 back, right? The capital intensive companies have the biggest challenge with this. The capital light companies, the companies that don't require money after money after money to get to the next, to have their next surge of innovation, are the ones that do the best. Apple, right? Even though they're a hardware company, their services business has been growing at over 20% a year for like 6 years now. So on this pullback with Apple iPhones, we may find a pretty good opportunity. You never know. I have said that instead of owning a bank, own Apple. Why? Because Apple is safer with more growth and more money. Apple's got more money than the banks, and they don't have all that loan risk, all that economic risk. So if you own bank stocks, sell them, every single one of them. Nobody should own bank stocks ever. I made that clear. And find substitutes that benefit from the same things but don't have all the downside. Apple is one of those companies. Google probably is too, but they don't pay a dividend. And I know that you're in love with the dividends that the bank stocks have, but think about 2008. If you don't remember 2008, go pull up the long-term chart of Citigroup, of Goldman Sachs, of JP Morgan, of Bank of America, of Wells Fargo, all the banks out there. Go pull up those charts and see what happened to them. I'll show you one in a minute. I'll show you Citigroup in a minute because they are, to me, one of the worst banks in the world. So when we invest for growth, we have to look for innovation to drive growth. And the companies that are able to continue paying their dividend have some sort of new innovation coming, right? They can just keep pushing this out a little further, a little further, a little further. And some companies are pushed out for a decade or 2 decades, like Apple. Apple's not going to stop paying a dividend this half of the century. And it's going to keep growing for, at least until the millennials are very old. So, Apple is a great company to pay a dividend, and it's going to keep going up. They may not have great share appreciation in the future, but it'll be at least as good as a bank, probably better than a bank, probably better than the S&P 500. And when they're paying a 4 or 5% dividend at some point, and they will, because they're buying back shares, there you go. Apple is a better bank than the banks. It's got a better secular story. So, I pulled this up. This is a chart just to enforce it in your head that dividend investing doesn't win when you just focus on yield. Invesco QQQ pays about a 1% dividend. Invesco Midcap Momentum Return, I think less than a 1%. I think they're both less than a 1% dividend. They just have some residual dividends from some of the companies in those indexes. Then here are the 3 most popular dividend ETFs. Vanguard Dividend Appreciation, Invesco S&P 500 Low Vol, and the iShares Minimum Volatility. Green is Invesco QQQ. And I go back further on this, but the other ETFs are newer. But you can compare QQQ to the S&P 500, which we've done over and over again. S&P 500 has about 2.5 times the dividend of QQQ, and yet QQQ beats them over every single time frame. QQQ, which is the NASDAQ 100, your Apple, Google, Netflix, PayPal, Biogen, those companies of the world, Amgen, Comcast, I think Viacom's in there. You know, there's a spread. You know, it's about 60% tech, about 25, it's about half tech, and then about a third consumer discretionary, and then a sixth everything else, and a big hunk of that sixth is biotech. So you take a look at that, and you say, okay, why does QQQ beat all the dividend strategies? And the second best strategy is a momentum strategy for mid caps. And why would mid caps be important? Because those are the companies that get added to the S&P 500 when a company drops out. The smallest companies in the S&P 500 are under $10 billion, between $5 and $10 billion. And there's mid caps in that 5 to 10 billion range that are growing versus shrinking, right? If you're in the S&P 500 and you're at 5 to 10 billion, you're shrinking. If you're at the top of the mid cap index, 5 to 10 billion, and you're growing, you're likely to get added to the S&P 500 at some point. There's criteria, but in general, that's what happens. So when I focus on growth stocks, I'm looking at 5 to 10 billion dollar companies. Why? Because once they get added to the S&P 500, they get all that money from the S&P 500 pouring into their stock shares. That's nice for us, right? It pushes the price up even further. So if we can find those 3, 4, 5, 6, 7, 8, 9 billion dollar companies, as they're growing to the point where they'll be added to the S&P 500, that's what we want. That is past the speculative stage. So in any case, you take a look and you see, wow, you know, this momentum fund is all over the place because it's a momentum strategy, but it still did over almost a decade beat all the dividend strategies. QQQ crushed it. And this is a total return chart. This is inclusive of dividends. Invesco, low vol is one that I use. I also use the iShares min vol. I don't really use Vanguard. Vanguard's not as good as these other two, the iShares and the Invesco. Just throwing that out there. If you're in VIG, you can upgrade if you like to. And I'm not saying that you shouldn't have money in dividend stocks. I'm just saying pick the right dividend stocks, the ones that have growth characteristics, the ones that aren't at risk of this. And if you're using funds, you just have to pick out funds that screen somehow for that. And there's several of those factor-based funds out there now. Simpler is better. You don't need more than a few factors. You know, when somebody says we got 37 factors that we consider in our ETF, tell them to go pound sand. It doesn't matter. They cancel each other out. All you really need is a high Petrovsky ratio, right? You look that up. You need something that you're relatively safe, and then you need something that has a growth rate. And companies that have negative growth rates generally are in banking, fossil fuels, and a few other industries. Try to buy ETFs to steer away from that stuff. So, growth stocks. What do we know about growth stocks? Peter Lynch told us that all you need for a lifetime of successful investing is a few big winners, and the pluses from those will overwhelm the minuses from the stocks that don't work. And remember, if you pick a loser, you get rid of it kind of quick. We've made some mistakes, you know, but if price goes against you, just don't say everybody's dumb. Say, okay, what do they see that maybe I don't? And it took me 2 kicks in the butt to figure out what I needed to figure out about fossil fuel stocks. With those, I didn't understand off the bat that the divestiture movement was so successful. Over 1,000 institutions have announced divestment plans, and I think it's up to like 1,500 now. So when there's an extraneous piece of information that you miss, you have to adjust for it. And I've done that with fossil fuels. I love the fossil fuels when they made me money. I'm not one of those haters that think that we couldn't have done with the world what we've done over the last 100 years without it. We needed oil and gas and coal. Now we need to move away. We have the technology. We have the money. So the secret to growth investing is you need a secular tailwind and avoid outright speculation. Outright speculation can destroy capital. You need to know where a company is going, not just hope or roll the dice. Say, well, if I roll these dice enough times, I'll roll a couple sevens. Nah, that's tough. Do you know anybody who really wins at the casino that's playing against the house? So, in any case, I want you to consider what I've talked about for the growth investing. I'm not going to show the list on the screen here. This is for members only. But we have some criteria: secular trend that is supportive, benefit from or at least neutral with regards to government policy and Federal Reserve actions, solid fundamentals, and a real comparative advantage. And then show signs that the stock market will be supportive of long-term price appreciation. I'm looking for double-digit revenue growth over the next 5 years, strong returns on invested capital. Take a look at something called the magic formula. Reasonable debt levels that are declining over time, a strong or improving Petrosky scale F-score, and strong or improving shareholder yield. That's what I'm looking for. And a lot of times with these companies, these scores aren't real high yet, and other people screen out for them. A better way to screen is to use the formula building function and whatever you're using. I use Stock Rover. I think Stock Rover is outstanding. And you compare and say, okay, I know that it's starting with a mediocre score here, but is it improving? Right? That's what you look for. Is it a 5 now going to a 6 and a 7 later? Is shareholder yield, has it gone positive yet? Once shareholder yield goes positive, growth companies usually see a really good run, and just barely positive. So from negative to positive on shareholder yield, that crossover is a big deal with growth stocks. Now, shareholder yield, when you're looking backwards on a dividend stock, you want to know that shareholder yield is higher than the dividend yield. That's how you maintain it. Shareholder yield is the combination of stock buybacks, dividends, and debt reduction. So basically, giving money back to the shareholder and reducing corporate leverage. That's a great equation. So you need to see improving shareholder yield for growth stocks. And for dividend stocks, you have to know that it's strong and stable at least. Let's take a look at some companies. There we go. So I'm going to actually start with Apple since I talked about them. And we'll go to our full featured list, full featured chart. Just go down to 5 years here. So in 2000 and, must be pretty far back. Let's see here. We don't need this. Oops, wrong way. There we go. I was writing for Market Watch. Split adjusted price got down to 58, 57, 58. So right here, Apple had come down like 30 or 40%. I told everybody right in here to buy Apple. You can Google the article if you want. Just my name, Kirk Spano, and I think the title of the article was "This Apple's Not Rotten," something like that. Rotten and Apple, probably Kirk Spano, Rotten Apple. There you go. You'll probably find the article. So at 58, I told people to buy this stock, and around 200, I said to sell it. So I missed the last part of the rally. Really, You know, I should have, I traded it a little bit in here, and I should have just held on a little longer. But by the middle of last year, I was convinced we were in trouble. So you take a look at Apple, see, where is this stock going? Well, the longer time frame you look at, this is a monthly chart, the easier it is to see what's going on. This green means that institutions love this stock. Berkshire Hathaway is one of the big buyers. They're not buying it now though. He said he wouldn't buy it at 180. My guess is that he'd buy it around 225. So you take a look at this and you say, okay, what do I know about Apple? I know that they have more money than God. I know that institutions love them. I know that the secular tailwinds are on their side, right? And with their services and their new subscription revenues, they might even make more money than just selling telephones, which have to be replaced about every 3 years. You know, they want you to replace them every 2, but let's be real. We should all keep our phones about 3 years for sure. And I don't know how much better these phones can get, to be honest with you. The cameras are better than professional grade cameras from just 10 years ago. You know, the computing power is off the charts. And now with 5G and the Internet of Things, imagine what you can control with your phone, what you can do with your phone. Right? It's a supercomputer in your pocket for sure. So when we take a look at this, we take a look and say, okay, when was the last time the money flow wasn't so good? And that's right in here. And that price is right around 216, 225, 210, right? This is the last time that the market really sold off on Apple. So I think that 225 range, which is why I mentioned it with Buffett, is probably where you see big institutional buying again, right? Everybody's raising money right now. And we saw last Friday when gold sold off, that was the fund margin calls. You know, people are like, well, what do I have that I can sell to fund my margin calls? And it was gold. They should have sold off the crappy stuff. Apple is a source of liquidity. So you can see Apple go down as much as everything else. But once Apple stops going down at around, you know, somewhere between the 200-day moving average, which is 280-ish, and then down here where the big buying took off again, 225. So Apple between 280 and 225, 275 and 225, that's probably where you see the market change directions too, because Apple is such a big component of the QQQ and the S&P 500 and the technology indexes. So keep an eye on Apple as kind of your harbinger as to when this market is going to turn back around, turn back up. I don't think this market turns back up until Apple at least tests its 200-day moving average, right? So around 280, 275. And potentially it goes down all the way to 225. Now, if Apple goes down to 225, we're going to take a bite out of Apple. At 275, dividend investors should take a bite out of Apple. You know, if there's not still downward momentum, right? If there's downward momentum, hold off. Wait till things stabilize. And my very strong suggestion to you, which is why I had the Eisenhower video on at the start, is that I think probably seeing a sea change in political motivation in this country. So I think President Trump is likely to lose. You can argue with me if you want. I've been taking $100 bets on it with my friends. I am in the distinct minority where I live, what I think is going to happen, but I have inside information. I try to tell people, hey, I know what the private polling data is, and that's not what you see on TV. So I know the knee-jerk reaction is to say, yeah, well, yeah, they said that last time. No, they didn't. The people I'm listening to predicted that Trump would win. And the people I'm listening to, the same people, are now saying he's going to lose, and it's probably by a lot. So he's either going to lose or he's going to lose by a lot. Depends who he runs against, with, and other things, but he's probably going to lose. He's probably not going to get 60 million votes. So, at least the never Trumps are back. So why is that important to talk about? Because if that's the way it shakes out, if Trump loses, there'll probably be big selling right after that. Not only by people who just have knee-jerk reactions, but because the wealthy, who have already been trickling out of the market for a year, and we've talked about that over and over again, would accelerate their selling. Why? Because they need to lock in those tax rates. Whether Biden or Bernie win, tax rates are going up if you're wealthy. Probably not going up on you if you're in the middle class. Bernie, he would never get his health care plan through Congress, so it'd be something in between. But the reality is tax rates on the very wealthy go up no matter what under a Democrat, and probably rightfully so. So if you're making $500,000 or more a year, and it's probably all the way down to 200,000, so that'll, I might have to deal with that. But at $500,000 a year, your taxes are going up. And in particular, if most of your income is through capital gains and the carried interest exception, which is basically gives you a capital gains rate for income, that's where the big hits are going to be. People in the financial sector are going to pay higher taxes. And that's really what it boils down to. But those folks are going to sell off. Private equity guys are going to sell off. So if it looks like Trump is going to lose, and then he does lose, expect a really bad fourth quarter. And that's why I throw that warning out there for you, because you can't say he's not going to lose. You can say, I think he's going to win. I think he's probably going to win. I think the opposite. But the reality is who cares what we think? The fact is it could happen. And if it happens, tax rate investors are going to make changes. So I'd be cautious about buying much of anything between now and the election, and keeping some powder dry. Now, that doesn't mean we don't want to buy some things. Certain things are already cheap enough. I've talked about Nutrien over and over again, and I wasn't going to, but I'll just, because they got some upgrades this week, and pretty much everybody that is with me is already in Nutrien. We need the American one. Right? Let's take a look at the daily. And right. So the daily chart on Nutrien has been chopping around. It's double bottoming right now. And it's through what I thought was the buy zone. So you're at bottom fishing prices on Nutrien, and they just got upgraded by like 3 different investment banks. So I'm not going to go too much into the story on Nutrien, read my stuff. But Nutrien is in a great position. It's an oligopoly, part of an oligopoly, the number 1 producer in an oligopoly, and all these extremes on the daily and the weekly, right? Now, there was a merger, right? It was potash and agrium merged. But look at the extreme oversold. Money flow is down. MACD is negative. But look, it's close. This is a stock that when the market does rebound, it's going to go up. And over the decade, we need, because we lose a couple percent of our arable land every year, we need to refurbish the land that we have, the arable soil, the farmable, right? You got to be able to farm it. That land is getting destroyed by climate change. Fertilizer is a big deal, and potash is super important. So keep an eye on this. All right, let's look at some other S&P 500 stocks, some Dow stocks, really. Boeing's been in the news. Why? Because of the 737 MAX, which isn't so MAX. You take a look, you say, my gosh, it's been range bound anyway for a couple of years. And it peaked and it's coming down. I put this level in here. That's the warning level, right? This is the spot where if there wasn't downward momentum, we'd look at buying. There is downward momentum. So we have to keep going down. 223, 196. This is the area where I actually think the new buy zone is for Boeing. Where's my shapes? Rectangle. There we go. So right there. This is probably where we want to buy Boeing. Right in there. Around $200 a share. Could it go even lower? It could. If we start hearing news that there's massive lawsuits against Boeing, it could go lower. It could erase a decade of gains. It could go all the way in. Give me another square, please. Thank you. It could go all the way down here. Right? It could get all the way down to around, low hundreds. Maybe even under 100. So this would be where if there's all kinds of lawsuits against them, and this is probably just where institutions start buying. So short of lawsuits against Boeing that are, egregious, I'd say probably this is the box you're looking at. Around 200, not around 100. Disney. Disney has become a company that we look at. Why? Because they're adding subscription revenue. That big pop, that gap just filled. And would I like to get Disney under 100? Right down in here. Give me my shape. I need to lock that in. If I could buy Disney, right? That price range in the 90s. I had a chance. I knew I should have bought it. I didn't. And it broke out. See, it broke out. I don't know that we'll ever see this box again. So that's about 102. This, we're probably about where we need to buy it in normal circumstances. Coronavirus maybe gives us this again, under 100. But we're getting close on Disney if you're a Disney believer. I like Mickey Mouse. I like the fact that I think the parks are going to keep doing well. I think that all the purchases they made of content are a big deal. I think content is king. I think Disney's streaming channel eventually goes up a couple bucks. I think Hulu is going to be a big deal. I think they're going to compete very well with YouTube TV. And they play nice with Roku, which is important. Roku is a company on our list that, there's a certain price to buy Roku again, too. But Disney, if you like the Mickey Mouse Club, you're getting close. And because these two levels are so close, unlike Boeing, which are separated by $100, these two ranges are close. You might get it under 100. Cisco. 5G world, right? They're in the Dow Jones Industrial Average. And look at that line. It's almost like I put these lines there for a reason. Look at that. Hits that line. Seriously. Take a look at how good we're hitting these lines. We're using RSI, Shaken Money Flow, and MACD. Wow. If you're a member, you should be looking at your lists, right? The reason I have those bull support levels is because they're potentially tradable. And I don't know what your risk level is and whether you want to trade anything. But if you think we're getting a rebound on Monday, you can buy at these red lines. Now, I think the likelihood is at some point we go down here, right? We go down to 32-ish on Cisco. But at 38, you don't have giant risk, right? So if you want to buy Cisco here, You're doing it because you think there's a rebound coming. I'm not buying it yet. But you could, right? You could think I'm wrong. But again, look at this. Look at my red line on this one. Bam, we're hitting it right now. Remember, these red lines, I put these in here weeks ago. The stock was trading at 208 when I put these lines in. Oh, it's not going to drop $40 a share. Well, look at that. It did it in a month. Now, this level down here is possible too. Visa could go to 150, and if it does, back up the truck, right? We're just at this first support level. And what have I been talking about the last few webinars? Probably the first support level is not going to hold. Can you get a bounce off of it? Yes. And what have I told all the members, all the subscribers to do if we get a rebound? Sell into it. So I do think we're going to get a rebound, but it'll only be a little bit, maybe back up to 192. Then I think it heads back down, because I think that the economic damage from coronavirus is going to be significant. We're basically going to lose a quarter or two of growth. That's important to valuations in the stock market. Microsoft, another company that is just outstanding, and they've come back from 190 all the way down to 160. Now, the inclination, let's see where my red line is on this one. Look at that. Right? And I don't know that I saved this one. Oh yeah, I guess I did. And these are all pretty close. Maybe I picked these on purpose. All right. So Microsoft is a great company. Shorten this up. When you look at it like this, you're like, oh, look, that's a nice rebound. That's a nice dip to buy. And then you come out here and say, well, look at this. This is probably where the support zone is, right? That gap up right there. I'm using weekly charts because that shows me a better idea what happened. So from about here to about here is probably the super good support zone for Microsoft, right? So 140-ish to 120-ish. That's what I'm looking for. And I think these red lines, I think I might have been taking credit for something I shouldn't have. We'll see. We'll find out with Exxon. Oh, no, I guess I was. Oh, yeah, here's my red line for these guys. Okay, yeah, I guess those were my red lines. Okay. I'm still learning how to use TradingView. Great software, more stuff than I've ever had to use. Because I've always been long-term, but I've gotten more into the technicals and the quant as of late. So Exxon, here's the thing. The article that I'm writing over the weekend, so that I have something being published while I'm out in Arizona and going to take a few days off next week, just checking in the mornings. The title of the article with Exxon is Don't Step in the Exxon Value Trap. I'm telling you, Exxon is going to do this in reverse. So just like Exxon went up and up and up and up for a couple decades, it's going to come back down. Think about that chart I showed you earlier, the S curves. What can Exxon possibly do to avoid going in reverse like this? Right? Just flip this over, make a mirror image. Exxon is going downhill, baby. And at some point, you can short it. Now, we'll get all the way back down to $6 or $7 a share again. I don't know. I actually think so. So I'm going to make that argument that Exxon is headed for oblivion. If you want to buy it, that's fine. That's what makes a market. But I think that the headwinds for Exxon are enormous. Nobody's going to buy their land. Oil's going to slowly go away until it suddenly goes away, right? We're already on that peak oil plateau, chopping along sideways for demand, and it's going to turn over by 2030 for sure by 2030, and I'm starting to think a little earlier than that. If you're watching the car industry, every single company has announced that by 2025 or 2026, they're going to be selling all EVs and hybrids, at least for mid-size vehicles and lower. Super heavy vehicles, you probably still have some diesel. Hydrogen's going to get some play. But look at the Tesla trucks. They're electric. And they're getting big orders. Look at their pickup truck. You know, the F-150, top-selling vehicle in America. That's going to go electric. Right? They're starting with hybrid, but it's going to go electric. The bigger trucks will go hybrid. But the F-150, which people really don't use for work, let's face it, they carry furniture around in it, but it's not an F-250 or 350. The 250s and 350s are the heavy-duty babies that, you know, you can put a crane in the back of. The 150s, that's just because somebody likes a pickup truck. They like being in a pickup truck, right? And they like to be the guy that comes over and helps you move the sofa or take the brush out of your yard. They're not moving concrete, right? The F-250s and 350s do that. And those will probably go hybrid, and they have a neat marketing pitch. You know, I've been following Ford very closely. So, you know, what's Exxon going to do over the next 10 years? The CEO is a moron. He's a moron. I'm telling you, he's a moron or he's a greedy freak. One or the other, maybe both. He might even be corrupt. Who knows? Might have no ethics. I don't know. There's nothing good I can say about the Exxon CEO. They are out of their mind to be increasing CapEx. They should be winding that company down over the next 30 years, conserving their cash, and looking for the next thing on that S-curve. They're making no attempt right now. So I think Exxon is going into the 20s in the next 5-6 years, and it might go all the way down into single digits. Now, I will also make an argument at some point that Chevron and Exxon should merge. They have similar liabilities, so I don't think it matters. And then they should spin off a bunch of the parts. So think about the Dow and who's double D? DuPont. Dow and DuPont merged, right? And then they split. After they merged, they split into 3 companies. So they put everything together. They said, okay, this stuff is going here, this stuff is going there, and that stuff's going there. That's what Exxon and Chevron should do. They should merge and then split back up into 3 or 4 companies that focus on different things. Maybe one of them's a REIT, right? Yeah, and then somebody just mentioned in the chat, GM just had a big battery announcement. I did not see that one coming. I had been thinking about shorting GM. So they're going to have a battery that goes 400 miles between charges, and they're going to compete with Tesla on price for sure. You know, they're getting rid of all their gasoline vehicles too. I was at the auto show in Milwaukee. I went to CES in Vegas in January. I went to the auto show in Milwaukee just a couple days ago. It was a crummy show. I'll tell you what. They need to improve the Milwaukee Auto Show, the Adam won't allow any of the electric vehicles. Basically, it won't allow Tesla for sure. There was only a state of Wisconsin thing going on that we got to see a Tesla, but the reality is that all the people there who travel with the auto shows, they know what's coming, and they'll tell you if you ask. We're in the last generation or 2 of gasoline sedans, crossovers, and small SUVs and small trucks. They're all going to be gone by 25, 26. Now here's the thing. Just in the back of your head, if you're willing to do it, you might want to buy one of those last models of gasoline trucks. Right? I don't know. You don't need a city car. Go EV for that. But you might want a SUV or a truck in one of those last models, because once the demand for gasoline starts going down, unless they add a big tax, gasoline's going to be cheaper a really long time, because we have way too much oil that's going to be out there for a while. In Saudi Arabia and the Middle East, they can pump out barrels forever. Not forever, but long enough. Even if fracking is really peaking right now, which I think it is, and turns over in 3 or 4 years, which I think it will, doesn't matter. There's going to be a lot of oil out there, especially with all the deep water. And especially if Exxon doesn't listen to me. If Exxon really puts $20 billion more into CapEx the next couple of years, we're never going to be short on oil ever again. So, all right. So I wanted to go through these charts, just give you some ideas of what to think about. Apple, I thought was important. Nutrien, I think you can buy right now, like today. And make it a percent of your portfolio if you don't have any. If it's already 2 or 3, maybe add another percent. But this is a company that I think has a bright future. Disney could be coming. Boeing could be coming. Cisco could be coming if you're a dividend investor. Visa. We have to buy Visa here for a while. But, take a look at the chart going back to 2018. It did get all the way down to 122 in December of 2018. Now, I'm going to show you the Goldman Sachs chart. Goldman Sachs just said today or yesterday that the downside on the S&P 500 was, surprise, December 2018 lows. I've said that every call, every webinar for 3 months now. Goldman Sachs now agrees with me. Interestingly, they don't see that low being broken. So either that's where they plan to start buying, right? That's where they plan to start buying. Or you get the zigzag and then a deeper correction. So keep an eye on their forecasts. Their baseline here is just what they started with a while before coronavirus. So they said 3,400 before coronavirus. Now they're down to 2,450 on the S&P. That's pretty big deal. All right, everybody have a great weekend. My grandson is over, and I have an appointment I have to go to for lunch. But take a look at the growth list. Take a look at the dividend list. Take a look at the must-owns. Those 32 companies, they should be on your radar. I gave you support prices for the top 10s, and the must-owns I'll work on this weekend for you. Have a great weekend, and if you want to sell puts on stuff, go ahead. Volatility is high enough to get good returns, but still keep in mind all the bottom fishing prices and where we have our support prices, right? Build a little extra margin of safety in for you. Don't stretch for premium. Just like you shouldn't reach out for yield, reach out for risk to get yield. Don't reach out for risk to get premium right now either. There's every reason to think that on Monday this market goes down 3,000 points. Why? Why not? It hasn't happened yet. And one thing that I will predict is that these 1,000-point drops, that's pretty orderly. That's not a big deal. Wait until we get disorderly. Wait until there's panic. Wait until you see the reds of their eyes. Right? The little algorithms finally panic, and then everybody behind them, with a Robinhood account. So, transportation. All right, everybody have a great weekend. Thank you very much, and I'll see you next week. Keep an eye out. I'll have a few more articles. Pretty much writing 3 to 5 articles a week now, as I have transitioned to doing this full time. All right, take care.